Renting versus buying comes up a lot when you're considering a big purchase. Should I rent an apartment or buy a condo? Lease a car or buy it outright? Rent that lawnmower or buy it so that damn crabgrass will never enter my domain again? For most of us, we rent until we can buy. But for companies, that decision might not be as straightforward. Sure, you have typical overhead like office space or fax machines, but what about items seen as core to a company's business? For example, did you know that most airlines don't own the planes they fly? That's right, we're all on leased airspace when we go to Ohio to visit our family. Like a landlord for planes. Planes Lord.
And enjoy the flight.
We'll settle the hot topic of plane ownership a little later in this episode, but first, we'll cover both the financial and strategic considerations companies consider when deciding between leasing or buying an asset, and how you can strategically weigh the pros and cons of both as well. So brace yourself, as we Pareto, should I rent or buy? Here at Pareto Labs, we make a ton of videos, content for you to watch. And to shoot this content, we use professional grade cameras, which aren't cheap. So we're gonna take you along the path as we consider whether to lease or buy our next camera. Here are some basic assumptions. If we buy the camera, the purchase price is $10,000. Will be useful for about 4 years until it breaks down or a sexier camera comes on the market. And we assume the resale value of the camera after 4 years to be $2,000. There are a lot of online camera resources available that brought us to these numbers. Now, if we lease, we can assume the lease term to be 48 months, aka 4 years, with an ongoing lease payment of $200 per month. By the way, we have a link to download this Excel sheet in the video description, so check that out. Now, back to the buying option. If we buy this camera for $10K and assume straight line depreciation, we'll be able to depreciate $2,000 of that $10,000 asset that you now have on your balance sheet. Think of depreciation as a non-cash expense that you can put into your taxes at the end of the year to keep you from paying as much. Yes, this is a #tax hack. So, take the depreciation, $2,000, and multiply it by the corporate tax rate in the US, which is 21%. And it comes out to $420 in tax savings. Folks in the know call this a tax shield. Lastly, in the buying option, we assume we can sell the camera at the end of its life for $2,000. Now, if we lease, we'll have to make $200 monthly payments totaling $2,400 per year. Guess what? You can also expense this lease. Take $2,400 times 21% and you get $504, effectively reducing net yearly cash impact to only $1,896. Well, now that we have our numbers laid out, let's evaluate. I'm gonna blow your math mind for a minute and say that even if you find the right or best answer on paper, it might not always be the best decision for your company IRL. It's not you, math. It's us.
You're giving me the it's not you, it's me routine?
Here are some money things to think about when making a decision. Total cash required. In the buy scenario, the total cash impact after the purchase of the camera for $10,000, the depreciation tax shield, and selling it at the end of its useful life is $6,320. For leasing, the total cash required is $7,584. So over the entire 4 years, buying will require less of the company's cash. Buying 1, leasing 0. Initial cash required. For buying, that's our initial purchase price of $10,000. For our lease, there's no down payment and the first payment in a monthly installment of $200. So leasing requires much less initial cash. Leasing, a big 1. Buying, 1. Timing of payments. While buying has a lower total cost, it has a large cash out at the beginning. By comparison, leasing has a smooth, even cash out over time.
Damn, we're smooth.
Aside from the benefit of smooth cash flows, which is good, Having expenses spread out over time allows the company time to generate revenue with the camera to cover the lease expense. Leasing pulls ahead with a big 2, and buying still at 1. EBITDA impact. Okay, EBITDA is earnings before interest, taxes, depreciation, and amortization. Want to know more? Check out our course on how to read financial statements. Cheap plug over. For buying, there would be no impact on EBITDA as depreciation isn't included in your profits and loss. Leasing, however, will reduce your EBITDA for all 4 years. And now we're all tied up 2-2 for buying versus renting. Look, no one metric is universally better than the other. It depends on the company and your situation. If you have a lot of cash on hand, that initial purchase price might not move the decision needle. But here are some things that could. Now, it pains me to say, but Diddy was wrong. It's not all about the Benjamin. Well, not only about the Benjamin. Partially about the Benjamins, forget it. Here's some quick hits on other things to consider when buying versus renting or leasing. Number 1, you buy it, you own it. Want to make the camera purple? Go for it. Wouldn't recommend it, but you could jokerify it if you wanted to. Number 2, increase in value. If it's worth more over time in the market, it becomes more valuable. Number 3, incentive to maintain. You remember the last time you rented a car to go to Las Vegas and then it went missing and was found completely wrecked with lots of evidence in the trunk?
Remember, what happens in Vegas stays in Vegas.
Yeah, if you own something, you'll keep it nicer. That's a plus. Now, here are some non-financial advantages to leasing. Number 1, flexibility. Leases can be stopped early, usually with a penalty, or you can roll over a lease midterm for newer or better equipment. Kind of like upgrading your phone while staying on the same plan. Number 2, try before you buy. Sometimes a short lease is better to know if the camera's a right fit. Also, some leases allow you to buy the item mid-lease if you're really enjoying it. Number 3, get the latest and greatest. Sometimes there is wisdom in renewal. If you're always leasing top-flight equipment, then it keeps you from having items in the inventory gathering dust. Sorry, VHS camcorder, but we had some great times, didn't we? Hopefully, this sheds some light on buying versus renting. But if you're still stumped, and because I like you, here are 2 other options for you: financing and outsourcing. Financing is a pretty common practice if you've ever bought a home or a car. Here you actually own the asset, and so you get all the benefits that come with it, except you don't need to make all of your payments at once. You borrow for the initial purchase, then pay the bank or equipment house for the camera back over time. The kicker for this one? Interest, baby. Interest is the cost to borrow the money, and it compensates the loaner for the risk that you may not pay the money back. Also, the camera is usually used as collateral, meaning if you don't pay, the camera gets it.
I will find you, and I will kill you.
Meaning you have to give it back. No one is smashing that camera. It's too expensive. Another way to get access to assets that differs from leasing or buying is outsourcing. For the example of Pareto's camera, instead of buying or leasing a camera, we could hire a firm to shoot our videos that have their own cameras and equipment. The only disadvantage here is if you're filming a lot, it can get pricey over time. Okay, so what's the best move for us in this camera? I think for now, we'll rent. By the time this video gets edited and published, I'm sure there's something better out there, and maybe we can move our lease over. But one day, we'll find that perfect camera and put a ring on it. Thanks for watching. If you like our videos, do the YouTube thing and subscribe. But more importantly, sign up for your 7-day free trial of our growing Pareto Labs library and practical MBA curriculum. It's the faster, less expensive way to get an MBA level education without getting ticketed because you parked in the closer university lot. Come on, man. They know everyone wants to use that lot.